Welcome back to Halftime Report on CNBC-TV18. Nifty trading at the day's highest point, 26,170 levels. But let's move on. And India is capable of growing faster than 6-7%. That's the word coming in from Prashant Jain, founder and chief investment officer at 3P Investment Managers. Also adds that he prefers large caps over small and mid caps. Listen in to the excerpt from that conversation.
I compare India with its own past, and I feel optimistic about that. And so, I think 6 to 7% should not be difficult, but I think we are capable of growing faster. In 2000, blue-collar salary in Mumbai was 4,000 rupees a month. A starting software engineer salary was about 30,000 rupees a month, 8 times that. Today, the both have converged. There are far more blue-collared in India than white-collared. Only 25% of Indians earn a fixed wage. That number globally is 50 to 75%. So I feel very optimistic about the rising purchasing power of blue-collared workers. I think in the past, if you see, I recall that when 3-year returns turned zero or negative, that is when the equity flows to markets will start moderating sharply. I think we have had 1 year of zero returns. As Sanjeev said, if another year goes by, then you could see some moderation. But I think the mutual funds, the regulators in India have done a phenomenal job at educating the investor about the long-term potential of equities. The biggest supply of stock is coming from the primary market. Foreign selling hardly matters now. You are getting 500,000 crores of fresh money into the markets every year, including mutual funds and other formats. And that is the supply of new stock. Let foreigners sell 50,000 crores, 1 lakh crores, it's okay. It is 10-20% of the supply. And I think that supply of new stock moderates itself to the demand. So I would say if flow goes down, the supply of new stock would also go down. So I think these markets are in a low volatility, lower moderate kind of returns. See, I think what has happened is this has been a narrative-driven market because pre-COVID there were 3 crore demat accounts. Today there are 20 crore demat accounts. And these 17 crore new demat accounts, they have no history. They had no accounts in the stock market before 2020. In 2020, the small mid caps fell the maximum. They fell 70%. The large caps fell 40%. Economic sensitive sectors fell a lot, and most PSUs were in economic sensitive sectors. So whatever fell the hardest has given the maximum returns. So 7 out of 10 investors have experienced these high returns, and they are wrongly extrapolating that, in my opinion. So I feel these themes have got there is business merit in those themes, but I think investment merit is clearly missing. So in my mind, clearly it is large caps over small mid caps. And look at it, in Nifty stocks, there is no supply of fresh stock. All the supply is in non-Nifty stocks. So I think that also favors large caps outperforming. I like large banks, I like insurance, I like software also. I am not so negative. Pharma is good, automobiles is good. I would be very cautious on consumer staples, white goods, brown goods companies, even retail companies. But even tobacco, telecom, oil and gas, utilities, these are also sensibly valued here. Last commentary, we described the current states of markets as a dialogue which is attributed to Ajit. I don't know which movie it is from. कि इसको लिक्विड ऑक्सीजन में डाल दो, लिक्विड इसको जीने नहीं, ऑक्सीजन इसको मरने नहीं देगी और लिक्विड इसको जीने नहीं देगा. So I think these markets are like that. The rapid demand of or flow of money to equities is not letting it go down, and the rapid supply, equally large supply of IPOs is not letting it go up.